As you can read, as of yesterday, Ken Griffin's fortune soars to $28 billion on Citadel Securities deal. This is a deal that is actually potentially leading to an IPO for for Citadel Securities as a company to start being public and have its own stock traded on markets. But some people might be thinking that this is the end of the whole short squeeze on AMC because now he seems like he has more money, because initially, before this whole deal started, his net worth was estimated around 21.3 billion US dollars. And this is kind of beyond some of the other, I will say, tech guys on Wall Street, because Citadel is really a tech company based on the algorithm as, a market maker and a hedge fund. So we have Vladimir Tanev, the guy from Robinhood. We also have Jim Simmons from Renaissance Technology Fund, and we also have David Taper. So as of today, he's now beyond, passing Jim Simmons, and is actually the richest hedge funder, as we call them, on Wall Street. So I'm going to share with you something moving forward in this video that is actually pointing to something totally different as a narrative and the story behind the scenes when you actually read in between the lines. Because we have another hedge fund. Also a quant hedge fund. By quant, we mean those hedge funds similar to Citadel Securities that use data, that use technology in order to make deals and make money on the market. All right. So they are closing after 11 years of trading. And the reason that they're mentioning it's really something that we need to take into consideration, because it's really important. And it has anything to do with what is coming for AMC stock in the short squeeze. Quantitative investing firm Solaise Capital Management is closing down after 11 years following a decline in asset amid poor performance. The London-based fund firm's systematic program was up 5.5% in 2021 and had lost 13% the year before, trailing peers over the period. According to an investor letter sent by Bloomberg, the fund was left with assets of just $51 million. And at some point in 2015, these guys were managing over $400 million at its peak. All right. So how come things are moving on the downtrend? Because at the end, this is a quantitative hedge fund. These are guys that are managing money and not supposed to be the smart guys, knowing exactly where to put money in order to double it, to triple it, for their clients. So what happens? Well, here's the story. It has been a tough environment for future traders, and our absolute returns have not been as we would have hoped. Ali Nejjar, founding partner and chairman of the firm. James Walker, a managing partner at the firm, confirmed the decision and said that while they continue to believe in the power of the trading system, asset levels were insufficient to support the business. And this is the key ingredient, the key information to take away from this news, from this story. Why? Because if, as a hedge fund, you were losing money consistently year after year, and after 11 years, you're forced to close, it's because, first of all, the strategies that you use, the strategies and, the sectors and the stocks that you decided to invest your money in didn't pay off, And instead of liquidating those positions, you may had the opportunity to either inject additional cash or, sell some assets. But why do you think they didn't have that chance? Maybe because after seeing poor performance, clients decided to pull money out. This is kind of what we are expecting, or this is kind of what is the trend nowadays on Wall Street. Because even for Citadel Securities, where we do have Ken Griffin fortune soaring and now being the most worthy or richest man on Wall Street, he is still preventing his clients from removing money from the funds. If not, they have to pay a pretty hefty penalty, a pretty substantial penalty. Why? If the business was doing so right, if the business is doing so well, why the heck will you prevent people from withdrawing money? Especially when we have almost 400 hedge funds that closed doors in 2020 and in 2021. So that is a big deal. So even if it seems like Citadel Securities is doing well because Mr. Ken Griffin is, actually getting more richer and more richer, I believe that even without margin calls, these little hedge funds don't even need to get to that point, because some of the strategies or bunch of the choices they make on where to invest money, especially short selling companies like AMC and GameStop, it's not working anymore. And they're losing money because not only the capital is depreciating, they're losing money on the position, but also they are paying hefty fees to sustain those positions. But this is going to get worse, because now bunch of these big banks that are providing liquidity, that are providing cash to these banks as collateral, are now saying that, hey, 2022, we might see a lot more changes in the monetary policy. Interest rate might get higher and higher and higher, even more than the Fed is telling us, meaning that it's going to be way more difficult for you guys to sustain your short positions as they are poor performing, as they're losing money. And then if you add the retail investors onto this thing, man, this thing gets just out of control. So we just need some few, not all of them to begin with, but just few of them, those who have like 6,000 shares, 4,000 shares, 10,000 shares short selling in AMC stock. We only need those to start falling for the domino effect to start. And you might not even need to have the margin calls, because as they start closing those positions, the price gets higher and higher and higher, to the point where at the 500, the 600, maybe not to the 500, at the 100, 120, 100, man, even for Citadel with this big money, it's going to be so much more difficult to maintain these short positions, and they will have no choice but to fold. And that's how we win the whole thing.